Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview.
Hi, I'm Remy Desai, Head of Content at Realosophy and Move Smartly Editor. My next guest, Shaun Hildebrand, is President at Urbanation. Urbanation is a leading data analysis firm for the condominium sector in the Greater Toronto Area. Urbanation's analysis is used by builders, the real estate sales industry, and government officials and other bodies. So I think we're going to be very well positioned to learn about what's going on with the condo sector, one of the most interesting sectors right now. I think one that faces the most questions in the wake of COVID. Hi, Shaun, welcome to the summit.
Hi, thanks for having me.
Shaun, I wanted to start by asking what a typical week of work looks like for you at Urbanation.
Typical week, wow. Urbanation's work is pretty diverse. On a given week, we could be working on a report. So we analyze and report on the new construction condominium market, the resale market, and the rental market. So we could be putting together reports for our subscribers. Also, a large part of our week typically involves working on custom market feasibility studies, mainly for developers that are looking to build new condominium or new purpose-built rental apartment projects. So that requires a lot of work as well. And, just looking for new research areas to expand into, improving the analytics and the internal database systems that Urbanation has. So yeah, it's kind of all over the place, but very enjoyable, and we have a great team that's incredibly enthusiastic and passionate about the GTA real estate market.
Now, you've touched upon and you've often noted that the three condo market segments that you cover at Urbanation, pre-construction, resale, and rentals, are interrelated. Can you expand on that?
Yeah. So typically what you see is the resale market tends to act as a leading indicator for the new sale market. So as the market's doing well, as it's tightening up, for instance, as prices are starting to accelerate, it typically provides a cue to developers that it's a good time to start launching projects, for instance. It gives them a broad-based indicator that demand is improving and market conditions for introducing new supply have improved. So usually within a quarter or so, you start to see more project launches occurring, and that tends to drive up new condominium apartment sales, and in turn tends to have an impact on pricing. You also begin to see increased interest amongst investors in the pre-construction market when the rental market is performing well. And that's something that we've been seeing pretty consistently up until recently, I suppose, with respect to the rental market and its feedback loop into the new construction market. As the achievable rents within the marketplace continue to grow, it provides added confidence to investors to continue to invest in pre-construction projects, which in turn has an impact on sales volumes and pricing as well. And ultimately, as these pre-construction projects complete construction, go through the development process, and ultimately add more supply through deliveries, it also has an impact on rents, right? As more supply enters the market from newly completed projects, you typically see a large portion of new condominium units go directly into the rental market, which inevitably increases supply and has an impact on overall rental market conditions. And that feeds back into the new construction market. So It is all intertwined, and yeah, we've been pretty fortunate that we've had a close pulse on all three markets.
That's helpful. So your firm has released the latest numbers, I believe, on the condo market. Do you want to take us through it?
Looking at new construction condominium activity heading into Q2, the market was what I would consider to be on fire in the first quarter of the year. Sales for new construction condos were up 85% year over year, off of a pretty low level in 2019, I'd say. But nonetheless, when you look at sort of the numbers trending over the last 4 quarters, we were moving up towards a new high in terms of sales activity. And the projects that launched into the market in the first few months of the year sold extremely quickly at record prices per square foot. We were seeing broad-based demand, not only for downtown core, investor-heavy projects, but as well more, I'd say, end-user oriented projects out in the sort of outer 416 and the 905 region as well. So the market was pretty much growing and firing on all cylinders. And I think it was actually fortunate for the new construction market that we didn't see any new launches occur in March as COVID-19 hit. So the projects that did come into the market came in within January and February. And because there wasn't any new launches really during March, the market wasn't caught in a situation where inventory wasn't being absorbed and the market was left with excess levels of supply that would inevitably have an impact on pricing. That wasn't the case. The market was heavily absorbed before COVID-19 hit. And then as soon as the pandemic came in, we saw developers shift very quickly to delaying new condo apartment project launches. So we were expecting actually to be a very busy spring, but most projects put their plans on the shelf. And for a time, we're actually planning to launch those projects in the fall. But now with the resale market, I think, outperforming most expectations, and prices holding steady, sales improving pretty close to where they were at this point last year, I think it's added confidence for developers to start bringing forward some of those plans. And in recent weeks, we've seen a number of new projects either launched or announce their launch. And the pricing within these projects has been fairly consistent with pricing that we saw in the pre-COVID-19 period, kind of within $800 a square foot to around $1,300 a square foot. I'd say in some cases there's perhaps a little bit of discounting just to sort of provide some assurance that sales would perform well in this period, because obviously we're dealing with heightened uncertainty. But for the most part, the markets for new construction has held steady, apart from some minor adjustments in price, and I'd say some incentives that have come mostly by the way of extended deposit structures. So I think developers are working a little bit more flexibly with buyers to stretch out their down payments over a longer time horizon to make the investment more manageable. But yeah, certainly the resale market has provided, as I mentioned, a good leading indicator for the new sale market. And it looks like we'll start to see volumes pick up in the third quarter of this year. The rental market, we just released our data today, actually, July 15th, and I think actually when we look back through the full quarter, the market obviously was exhibiting some weakness, and I think that's expected given the nature of the economic downturn, which was mostly felt by younger workers, lower income, less secure employment, which typically have a higher representation in the rental market, but also the drop in immigration, the evaporation of non-permanent residents and foreign students. You would expect to see some give back within the rental market, but the government income support measures that have come in have, I think, played a pretty big role in helping to provide at least a floor for the market. And what we saw was that most of the weakness in the rental side, mostly as it relates to condos, was concentrated within the downtown markets, which are the most expensive markets, those markets that have seen the greatest influx of new supply, either coming from newly completed condo projects or, in some cases, units that were formerly being offered as short-term furnished units now being offered as long-term units. And that's something that we saw a pretty big jump in listings for. In fact, when we looked at long-term furnished rental listings, the number of listings was up 52% year over year. it represented about 12% of the overall condo rental market, so it wasn't insignificant, but it represented 21% of the overall increase in listings. So this is a segment of the market that we're starting to see have a bigger impact on the market, but pretty localized, I'd say. And in fact, when you peel back all the layers and you look at what happened in the rental market in Q2, overall rents were down, I'd say fairly modestly by about 3.5% year over year on a per square foot basis. But really, most of that decline was concentrated within the higher priced, highly dense downtown markets, such as, you know, the entertainment district, the downtown core, downtown west, Liberty Village, City Place. These are markets that saw, you know, 7 to 15% declines in rents. And, you know, that ties back obviously to the reduction in demand downtown for the reasons that we discussed, but also the supply equation. And it's never been the case that we've seen supply and demand move in such opposite directions as they're moving in right now. So given the magnitude of what's happening, the fact that rents so far only declined by about 3.5% year over year, I think is a pretty good outcome so far. And then, you know, when we looked at vacancy rates within the purpose-built stock, they moved up to 1.8%. So, you know, they were 1% or less a year ago. Now they're getting close to 2%. The market's changing somewhat, but I'd still say, you know, still holding up pretty steady. And you know, most of the reductions in rent that we've seen coming from purpose-built units has mostly been through incentives such as 1 month free. That's pretty much the most common incentive that we're seeing right now in the market.
So I'm wondering if I can take you back a little bit. So maybe a tale of three forecasts. Back before COVID hit, so at the start of the year, what was your outlook for the condo, the average price, say, in the GTA area?
We were expecting somewhere around 6.5% for condo price growth for 2020. Actually, it looked like we might be short of that forecast when we were looking at how quickly prices started to trend early in the year. And we were actually starting to see double-digit inflation for condo prices in the first few months. And you know, I was actually getting a little concerned that we were going to see condo prices overshoot, because it's different from the low-rise market in the sense that, you know, the low-rise market was also picking up, but the low-rise market endured a correction throughout a large part of 2018, 2019. So we were seeing some recovery within prices within that segment, but the condo market basically saw no correction in condo prices through the 2017, 2019 period. So the double-digit growth that we were seeing was off of highs that were occurring in previous years. And you know, we were thinking that condo prices were starting to get a bit too stretched in terms of their valuation, and there may be a bit of give back. Yeah, with COVID-19 hitting, obviously the trajectory for prices changed, and for a little while it looked like condo prices were starting to decline. But as we progressed through Q2, actually what we found was that prices held up pretty steady. So when you measured condo prices per square foot on a quarter-over-quarter basis in the GTA condo market, they were actually only down 0.6% quarter-over-quarter. But in the second quarter, they were up 10.5% year over year. So that's pretty remarkable given the current circumstances, that we saw almost no deflation in condo prices. And by all accounts, the market still remains balanced. 3.5 months of inventory, you know, still supports prices where they currently are. And, you know, we're probably, you know, still probably on track for that forecast, but it's just sort of a bit of a shift in that we're moving from a very strong inflationary environment early in the year to one where, you know, prices are really starting to taper off.
So is your forecast for the end of for prices to land at the place you were expecting at the start of the year, by the end of the year?
Yeah, somewhere around there. We haven't finalized the forecast yet for 2020, but I think, you know, given the strong handoff for the year, and you know, obviously there's still a possibility that condo prices could decline, right? We could see some further disruption to the market as some of the government incentives are rolled back, and, you know, the other support programs such as mortgage deferrals get clawed back. We could see some impact on the market there, but you know, we could also see an increase in demand spilling into the condo market now that Banks are starting to tighten up lending, and CMHC has started to change policy with respect to qualification criteria. So typically, as this happens, as it becomes a little bit more difficult for first-time buyers to get into the market, usually in the interim, the beneficiary of this has been the condo market. We start to see an increased share of sales go into less expensive properties, which are primarily concentrated in the condo sector. And that could help to support the market as well. So there's a lot of different competing forces, I think, at play here. But I don't see really any indications right now that prices are set to fall in the immediate term. I think when you look at the balance of demand and supply in the marketplace, it would suggest that prices should hold steady or experience at least some minor inflation in the coming months.
So would you characterize that as the biggest risk to your outlook if there's a prolonged unemployment or downward economic, episode because of COVID, and then in the context of that, government assistance programs are rolled back? Is that the biggest risk you're seeing? Are there others?
Yeah, that's a big risk. Like economic fundamentals, the employment situation, incomes, these are all historically the biggest fundamental drivers of the housing market and pricing, and this obviously relates back to the condo market as well. So if those fundamental factors, which also include obviously immigration, don't pick up, then this creates a very significant headwind for the market. And you also have to factor in investors and what they ultimately may choose to do with their units. And for right now, I think most are actually still finding an outlet in the rental market. And one of the interesting stats that we found in Q2 is that more than twice as many condos were rented in the period than resold. So there's still a lot of volume happening in the rental market. Investors are still being able to rent their units out. They may be renting their units out at a lower rent than what they would have achieved at this time last year, but there's still pretty good liquidity in that market. And rental demand is actually holding up pretty well, surprisingly. And in fact, when you look at the number of units that were leased in June, they were within 5% of the number of units that were leased at the same time last year. So I think as the economy is reopening, as more people are getting back to work, as confidence is improving, I think some renters are looking to take advantage of some of the discounts that are being offered in the market. You're starting to see some stabilization. So that should encourage investors to continue to hold on to their properties. Now, if we get into a situation where the rental market continues to drop, vacancy rates move significantly higher than where they are right now, we could just see some of that investor-held stock begin to be sold off, right? So this would create more supply in the marketplace at a time when, demand is obviously not growing as quickly, right? So this could also represent a risk. I think, for right now, we're seeing demand mostly kind of spilling over from where it was in the early part of the year, right? There's a lot of people that have been in the market for a while looking for a property, looking for a condo that have been outbid or unable to get into the market for whatever reason. And now they're finding themselves, I think, in a more comfortable buying situation in a lot of cases. But ultimately, that demand engine begins to slow down if you're not adding in new immigration, if you're not adding in new employment. So, I think we're still kind of running on the fumes of where we were in late 2019, early 2020. But if we don't get that extra growth coming out of population and job creation, I think ultimately this rebound will be somewhat short-lived. So these are kind of the risks that we're looking at.
Yeah, so compared to March, things are looking up, and I think confidence is increasing. And yet, if we look at our economy, even our main streets, stores are barely open, restaurants are seated, having people all outside. We are very, very far from normal. Are you surprised by how quickly buyer confidence returned to the housing market and to the condo resale?
Well, I think everybody's been surprised by how quickly confidence has improved. I don't think really anybody expected that we'd be almost as close to where we were at this time last year in terms of sales volumes, just a few months into the pandemic, given how sharply sales activity and rental activity, for that matter, dropped in the initial weeks. It's really been remarkable how quickly things have bounced back. So I think to some extent in the ownership market, this does relate back to the nature of the economic downturn and the fact that there is a very strong majority of the working population that has been unaffected in terms of their income from COVID-19. And as well, within the rental market, most of the income that's been lost as a result of layoffs and job losses has actually been offset by the government income support. So this is creating some artificial support in the market, in that if we didn't have the $2,000 a month payments coming in, there'd be a lot of people that wouldn't be able to afford their rent. And if we didn't have a ban on rental evictions, there'd probably be a lot of evictions occurring as well. So the vacancy rate numbers, I think, are being held down because of government stimulus. Ultimately, I think this is propping up confidence, but it may not be propped up by fundamentals, right? I think there's sort of an illusion out there right now that things are great, things are moving well, but we still have some serious economic hurdles to overcome before we're in the clear, and we can say that we've moved out of this situation without really much harm.
And I wanted to touch on some of these longer term trends. Before I do that, going back to the pre-construction condo market, you mentioned launches that happened earlier in the year. And I think you mentioned that, I guess conveniently, there weren't a lot of launches scheduled for the time where COVID saw us in complete lockdown. Now new projects are launching. I'm wondering how many are on schedule to be launched by the end of this year?
By the end of this year, that's a tough one. I can say that what we've been seeing happening in the new construction market is largely playing out similar to what we saw after the financial crisis in 2009. So initially, almost no projects were launched in the first couple of quarters after the recession hit. But as you started to see a few projects come into the market and they sold well at respectable prices, you started to see more and more projects coming in, and that picked up actually very quickly. So within 3 to 4 quarters after the recession hit, we were almost back to normal in terms of new launch activity. In the first month or two after COVID-19 hit, we saw, I think, 2 or 3 new projects launched. So very few, very limited releases, competitive pricing. These were projects that weren't located in the expensive downtown market, in more suburban, affordable markets. And what we learned was that these projects did very well, which wasn't that surprising given how competitive their price points were, and the fact that there was just so much demand for these types of properties heading into COVID-19. But now we're starting to see more downtown core projects coming into the market. So I think with the acknowledgement that, yes, there are some examples here of new projects that have launched and have sold very well, let's start to test the market a little bit now and bring forward a new condo project launch, so we don't compete with all of those other condo projects that may be launching in the fall, right? Since there were so many projects expected to launch in the spring, the expectation is that there could perhaps be a lot of projects that come in the fall and oversupply the market. And a developer obviously doesn't want to launch in that type of an environment. So it'll be very, very interesting to see, out of the 10 or so projects that have announced launch in the coming weeks, how they perform, because we're looking at a variety of different projects here. There's some sort of 905 projects, there's some kind of within the ODA 416, and then we have a couple in the downtown market. But by all accounts, again, pricing has been fairly competitive. We're not seeing too many developers try to push pricing too far. And again, they're being more flexible in terms of what they're offering in terms of deposit structures, which I think is going to work in their favor. So if these projects do well, which I actually expect them to do, because there's obviously good indicators of demand coming from the resale market, and the fact that there's not really that much inventory in the new construction condo market right now, you'll start to see more and more of these projects launch in the fall and into the winter of this year. So I still think when you look at overall 2020, we won't see as many new projects launch as we would have expected to see pre-COVID-19, but we could see 15,000 units launch this year, which is a few thousand less than we would have otherwise seen. But it'll still be a fairly decent year, I think, when it's all said and done. But obviously, that is really dependent on how sales take place in these projects that are slated to come into the market in the coming weeks.
So the latest Urbanation report describes some of these launches as surprising. Is the surprising factor that the timing was moved up, or what made them surprising?
Well, I think just in general, it's surprising that pre-construction projects sold as quickly as they are because, as we know, most purchasers of a pre-construction project are investors. And investors, you would think, would be the most skittish in this type of an environment, right? A home buyer perhaps is looking to get in the market because they're making a long-term investment. They've been in the market searching for a property for perhaps a number of years. Now they're actually finding it to be a more balanced market. So they're pulling the trigger and they're making that decision. And they're okay if prices decline a little bit because they're planning to live in the home for 10 years and it's not really going to make that big of an impact over the longer term. But for an investor, you know, if you're in an environment where unemployment is in double digits and rents are declining, you would probably be a little bit more cautious investing in a pre-construction condo project because obviously your outlook for return on investment has diminished, right? You theoretically shouldn't be willing to pay the same premium as you would in the pre-COVID-19 period. But so far, that really hasn't been the case. We've seen investors with really unwavering confidence in the condo market. Now, I'll say the condo market hasn't been tested too much in the sense that we haven't seen, you know, a $1,400 or $1,500 a square foot, you know, 400 or 500 unit project come into the market to really test buyer confidence. But so far, the projects that have launched that have been competitively priced have attracted a high level of demand. So I think to some degree, it may suggest that investors that are active in today's market, they are too concerned with the short-term blip. At least they believe it to be a short-term blip. And they're looking at this over a long time horizon, recognizing that when you buy a pre-construction condo project today, in most cases, it's not going to be delivered for 4 or 5 years. So if prices are flattening now, you know, if you look at the long-term history of condo price growth in the GTA, which has averaged, you know, pretty consistently around 7% per year, they're expecting that trend will soon reemerge. And, you know, the same idea with respect to rents, right? We may see rents coming off a little bit, but it's viewed as sort of a temporary change for a market that has historically been undersupplied of rental properties with a vacancy rate of, you know, 1 or 2% and continued growth driven by strong factors such as immigration and obviously a strong local job market. So, you know, I think that could be the case. We could also perhaps be seeing external demand, right? So demand coming in from wealthy foreign buyers, for instance. These are sort of the things that we don't have answers to, unfortunately. There's not a lot of strong data on new construction condo purchasers that are overseas that perhaps might be looking at Canada as an opportunity to invest, given our stable political system, our response to COVID-19, and, you know, the fact that our neighbors to the south have been very exclusionary when it comes to immigration and obviously, you know, you could argue a mismanagement of the health crisis. So, you know, there's some that are arguing that you know, the Canadian market may come out of this in an even brighter light, and you could see even stronger levels of investment in the year to come.
You've touched upon how hard it is to get at that question of just who it is buying all these condos. Do you have a rough sense, numbers-wise, of the split between end users and investors, let's say in the Toronto area specifically? Yeah,
so one of the things that we can measure with respect to investors is what happens after the fact. So it's tough to know at the point of sale of pre-construction whether the buyer is an investor or an end user. But after the unit is completed, we can see what happens to that unit. So if the unit is immediately added into the rental market, it gives you a good sense that the purchaser was in fact an investor. Or if the unit was flipped, then the same sort of indication that that unit was purchased by an investor as opposed to an end user. So typically what you see is that when a new condo project is completed, about 50% of all the units go right into the rental market. So that would relate back to at least a 50% share of pre-construction investor purchasers. Now there's probably another 10% that sell on assignment or shortly after registration. So that would raise that share to about 60%. And there's also a portion of demand that basically just buys the units and holds them and doesn't really do much with them. So, if you kind of take all of those different shares, you might work back to a percentage of around 60 to 65%. And when you look at that percentage, one of the things that we do when we measure new construction condo sales is we look at the percentage of units that sell right at launch. So typically, when a new project launches, it first offers its units to its platinum or what they call VIP brokers. So these are brokers that are known to drive condo sales volumes really, really high. And typically these brokers will go to their investor clients first, and they'll get certain allocations. And if they sell very well, then those allocations increase for future projects that are launched by that developer. So there's an incentive there for the brokers to move these units as quickly as possible. And the easiest way for them to move it is to move them to investors who don't want to come into the sales center, look at the units, time and time again. They look at the plan, they look at the price, they do their comparable research, and then they make a decision very quickly. So going back, usually when these projects sell very quickly, it's a very good indicator that there's a higher percentage of investors. So what we were seeing since 2017 was that the percentage of new condos that were being sold right at launch through this VIP or platinum broker channel was about 70%. So in fact, it had risen. And in some cases, it's up to 80% in some quarters. So, historically, it may have been around 50, 60, 65%, but I would say over the last couple of years, that investor percentage share has actually moved up to about 70%. So this is important to realize, because not only do we have a higher percentage of new condos that are in development that have been pre-sold to investors, but we also have a record number of condos that are in development in general, right? So there's over 100,000 units between units that are in pre-construction and units right now that are under construction. And these units are going to be delivered, and they're starting to get delivered this year. And this is a big change for the market that unfortunately is happening at the same time as obviously demand is facing headwinds due to COVID-19. And we were in fact expecting that we could see as many as 29,000 condos reach completion in 2020 based on scheduled delivery timelines, and this is in the pre-COVID-19 period. And with the disruption to construction, some sites were shut down for a period. Some are obviously working with less capacity because of physical distancing, safety protocols. We've had to scale that completion forecast for 2020 down, but it still looks to be that we're on track to reach at least 20,000 units this year, 20 to 25,000 units, which could ultimately be a record year. And in fact, the highest level of completions that we've seen since 2014. So it'll either be a record year or the second best year for completions. And recognizing that this is happening at the same time that immigration is at a fraction of what it is normally. Usually Canada sees 25 to 35,000 immigrants each month. In April, I think we saw 4,000. In May, I think it was 11,000. So it's a very small fraction of what we normally see. As well, obviously, with an unemployment rate of 13% in Toronto, there's obviously not as much new demand being created for these properties. So this is something I think that the market is going to be challenged with, even as the economy reopens, right? We're still going to be dealing with this extra level of supply that the market hasn't been used to seeing. Last year, in 2019, I think we saw less than 15,000 completions, right? So this is one of the reasons why the market has been so tight. We haven't been delivering enough units to satisfy demand. And in fact, that delivery number has actually been declining, but things are changing, and things are going to be changing not only this year, but over the next few years as that 100,000 unit number of units, number of condos in construction and pre-construction ultimately get delivered, and ultimately were pre-purchased by investors who will make a decision to either add their units to the rental market, depending on conditions, or offer them for sale. So one of the things that we've been looking at is, what's the return on investment for these units, right? What is the outlook for investors to actually continue to hold on to these properties as opposed to offload them upon completion? And for the units that are coming to completion today, because of the fact that they were bought 4 or 5 years ago at prices that are 50% lower than today, they're still getting a very strong return on investment. And because of how low interest rates are and their holding costs, because the units were pre-sold and locked in at a price that's 50% lower than today, they're still able to generate cash flow. If they rented the units out, even at a lower rent level today, they're still able to pay off their mortgage, condo fees, and property taxes, and in fact, probably generate a little bit of extra income. But for the units that have been bought over the last couple of years, where the investors have been paying $1,000 a square foot plus, in some cases up to $1,500 a square foot, they're going to require a significantly higher rent level today to be able to not only cover their carrying costs, but to generate some positive cash flow. And we were under the assumption that even if rents held steady this year and perhaps continued to grow, they still would fall short of what these carrying costs would be in a few years. And now with rents declining up to 10% in the downtown markets, that's just digging a little bit more of a hole for these units to have to come out of to eventually achieve neutral cash flow. So it's going to be very, very interesting when we get to 2022, 2023, and we see these units come to completion and the investors aren't able to come anywhere close to achieving neutral cash flow. What they'll do, right? Will they put extra money down? Will they bump up their minimum down payment from 25% up to 35% or 40% just to get those units cash flowing? Or will they ultimately decide to sell, right? And what sort of impact will that have on the overall condo market? So these are things that we're paying very close attention to. And I think one thing that we can take away from this, what's happened in the COVID-19 period, is that because we haven't seen as many new launches happening this year, ultimately there won't be as many new deliveries at some point, 4 or 5 years down the road. So if there is a bit of an oversupply of investor-held units coming into the market that are challenged in terms of their economics, the slowdown in pre-construction activity today will ultimately, provide some level of supply buffer as those completions begin to dwindle later on in the period.
A lot of question marks. It's very interesting. I'm wondering longer term, whether you can touch upon just when the Toronto condo market underwent this change. So you talk about investor percentage rates of maybe 70%. Do you know when that shift between Toronto having a condo market that was largely, end user based to this rise in investors began?
Well, you know what, the new construction condo market has also always had a pretty high share of investors. Like, going back even to like the early part of the millennium when, City Place and, areas like Liberty Village were being introduced into the market, there was a high percentage of investors even back then. Now, it may not have been as high as it is today, but they were certainly an important factor in driving new condo sales. And I think a lot of brokerages and developers recognized this opportunity that, for one, the rental market was starting to improve, right? We were starting to see rental demand grow for the first time in a couple decades. And because there was no traditional rental supply being built, investors recognized this as an opportunity. They could buy a unit pre-construction, wait for it to be built in a few years. The rent levels would ultimately rise during that period of time, as did the actual value of the unit. They could rent them out, get a good return on investment, hold the unit, and the investment would make sense. And as the rental market continued to improve throughout the 2000s into the 2010s, we started to see investment demand pick up, and that also picked up as the resale market and price appreciation picked up. I'd say the peak for new construction investment activity happened in around 2011. In 2011, we saw about 35,000 new condos sell, and that was a record for the year. We'd never seen anywhere close to that at that point in time, and that was majority purchased by pre-construction condo investors. Now, I'll say that these investors are, and they have been, predominantly local, right? So I think there is a misconception that it's foreign demand driving the market, where, when you talk to all of the developers, all of the brokers, there is an element of foreign demand, and there's certainly an element of foreign capital that comes into the market. But for the most part, and I'd say even by and large, investors are local. And I think, as the condo market achieves a level of critical mass, it feeds back in. And, everybody knows somebody who's invested in the condo market. So they see the returns that have happened, and so they feel like they should be doing it as well. And I think there's been a strong movement towards investing in real estate in general over the last couple of decades. And one of the easiest ways to invest in real estate is to invest in a pre-construction condo, right? You put 10, 15% down. You don't have to actually close on the unit and get a mortgage for 5 years. So you get the benefit of having that time horizon where the unit appreciates, but also the return on investment that's from a minimum 10 to 15% deposit. You know, obviously at completion, you have to put down the extra 5% to get to 20%, but those leveraged returns on investment are massive. And it's worked out extremely favorable in condo investors' portfolios because they've seen the value of the units appreciate, they've seen rents grow. But, you know, there's an argument to be made that, you know, those massive gains may be in the past. And the fact that, you know, we're moving from an environment where condo prices have been appreciating into the double digits where, you know, maybe they'll flatline for a period or grow modestly, as well as the rental market, that it's going to be a little bit more difficult. They have to be more creative in finding those opportunities. Not to say that they aren't there, but, you know, looking for those value-oriented sites, I think is something important. And sorry, as I'm speaking, I'm realizing that I misquoted. It's 2017, sorry, was the record for condo sales, 35,000 units. But back in 2011, it was 25,000 units, which at the time was a big, big year because I don't think up until that point we had seen anything, you know, close to that level. But, you know, 2011 was the peak back then. We experienced a bit of a downturn. 2017 was, in fact, when we last reached our latest high, which was 35,000 units. 2019 was actually a very good year, 26,000 sales. So we were kind of trending back up to that 30,000 unit a year level. And, you know, I don't think there's anything wrong with selling 30,000 condos a year because ultimately we start construction on maybe 20 to 25,000 units a year. We build on a good year, maybe 10 to 15,000 low-rise housing units. So, you know, housing construction starts have consistently remained around 40,000 units a year, which is in line or even below demographic requirements when you look at long-term historical trends for immigration. So, you know, there's nothing wrong, I think, with investors driving new condo sales. But you know, they've been the primary source for new rental supply in the GTA. In fact, condos have represented about 90% of all new rental supply created in the GTA over the last 2 decades. And now condos, which are condo rentals total around about 140,000 units. They represent about 25-30% of the overall rental supply in the GTA, much higher in the downtown market. So, you know, they're very important. They'll continue to remain critical to the housing market. But, you know, we are also starting to see more traditional purpose-built rental development occurring. And we've talked about this in our latest reports. It's picking up off a very low level. We have about 13,000 units under construction. It's the highest level since the mid-1970s. But, you know, it's still not anywhere near, you know, the 70,000 plus condos that we have under construction. So eventually, I think developers are getting on board with purpose-built rental, and we have a growing supply pipeline of proposed projects. But that's something that's going to take, you know, a decade to ultimately come into the market, maybe even longer. So, you know, for the foreseeable future, it's condo investors that we're going to have to continue to rely on to supply rentals, because ultimately, you know, we're going to come out of this situation. The economy is going to rebound, and what we'll find is that we're still left with an undersupply of rental properties, right? It may feel like this year and perhaps next year that we have an oversupply of rentals and that we've been building enough rentals, but I can assure you that this is going to be a temporary situation. And as we move over the medium and longer term, what we'll see is a return to low vacancy rates, growing rents, and ultimately what we believe to be the case is an undersupplied rental market.
So looking at this condo buying behavior, another question people have had is around this idea of premiums being paid for pre-construction condos compared to resale for some time. Why is this considered unusual? In fact, economists call this irrational behavior.
Well, there's always been a premium for pre-construction over resale. And when I say resale, I mean comparable resale. So let's say recently completed within the last few years buildings. So generally you'd see, you know, $50 to $75 a square foot premium for pre-construction over resale. That's historically kind of been the average. And, you know, that factors in, I think, the fact that these pre-construction units are targeting investors, right? Investors who don't have to close on the units for 5 years. They get the advantage of having, you know, not to put down, you know, all of their money and still get the 5-year appreciation that occurs between pre-construction and completion. And also, you know, there may be some advantages to the project. There could be some features that would be above and beyond what's being currently offered in the resale market. So I think, you know, to some degree, you know, those premiums have been justified across time. But, you know, there actually was a point, I'd say it was around late 2016, where we actually started to see resale prices surpass pre-construction prices. And I was looking at these indicators, I was thinking, okay, the new condo market is going to catch fire. And it did. It did in 2017. Investors are recognizing there was incredible value because they could buy a pre-construction unit that was actually lower than a comparable resale unit. And so, that value is already baked into the pre-construction price. They only have to see you don't even really have to see the value of the unit appreciate in order for it to be worth more at completion than it is today. Whereas with a premium of $50 to $75 a square foot, you'd only have to really see, modest increases in prices in order for the value of the unit to catch up. Also, when you buy a pre-construction unit, you don't have to rent it out today, right? So you have the ability for rents to grow over the 4 to 5 year period to ultimately be at a level that will cover your carrying costs. So that advantage of having future rent prices impacts the pre-construction price today as well. So that's part of the premium. But what I will say is that as pre-construction prices trended up very quickly after 2017, we started to see that premium for pre-construction over resale grow to record proportions that we've never seen. So, whereas it used to be $50 to $75 a square foot, it was now like $200 to $300 a square foot in some cases. And it started to make less sense, I'd say, to invest in pre-construction when you had to bank on resale prices growing that much more to catch up, as well as the rents being at a level that will ultimately allow you to achieve some sort of level of cash flow. But one thing that we started to see, and the market dynamics are continually evolving, was that actually as we moved through the end of 2019 or into early 2020, we were starting to see that gap start to shrink again, okay? New construction condo prices were starting to level off, and we were beginning to see stronger appreciation in the resale market. So that gap was actually starting to close again. And in a lot of cases, you could find a pre-construction condo project that was priced very close or within maybe $50 to $100 a square foot of a recently completed resale building. So it started to make a little bit more sense again. Those sort of divergences between the premiums in both markets started to close, and it started to kind of move back in favor of investors buying again. So, I think, kind of going back to your earlier question, there's always been a premium. At times it gets stretched, but it tends to move back down as the market kind of finds its balance.
So I'm wondering if there's a little bit of a distinction between end users and investors then, because traditionally the thinking has been that buying pre-construction should be a little cheaper. Maybe it's for the average buyer because you are tying your money up in a project that may or may not happen versus resale. But what you're suggesting is that, with a large amount of investors in the market, they're looking at other factors.
Yeah, and I'm not suggesting that the entire market is investor driven. There's a large proportion of condos that are bought by end users, and these end users are looking at these projects and perhaps willing to pay a premium because they can't find what they're looking for in the resale market, right? The resale market for condos has been incredibly tight over the last number of years, and if they can't find a property that's suitable to them, they'll go to a developer, a new development project, and they'll be able to have more selection. They'll be able to perhaps customize the unit to some degree. They'll get the advantage of buying into a brand new building. In some cases, they have the flexibility of deciding either to move into the unit when it gets completed or renting it out. So there's premiums that can be justifiable between both end users and investors, but typically what you see is that premium for pre-construction over resale tends to be higher within more investor-dominated projects, I would say. So, the very downtown focused, tall tower, small unit, those types of projects tend to see that premium a little bit higher. But yeah, certainly you do see those premiums within all types of projects. Not always, but in some cases you would.
Shaun, the theme of our conference is smart caution. What does that mean to you?
Smart caution. I think it's understanding the real estate market, examining the data, understanding where we are today, where we've come from, and sort of looking at the indicators to make a judgment call on where we could be. But, I think it's, the caution aspect of it is certainly looking at the big picture and not taking your eye off of what's happening around the world, right? We're in an unprecedented situation. Like I talked about earlier, right? The fundamental drivers of real estate are factors such as employment and population growth. If those fundamental factors aren't there or have, sort of a negative outlook, that should factor into your decision making. So, understand that, right now the market seems to be doing well, and there's a lot of the important factors that are helping to support market valuations. But there are risks, right? You need to understand the risks, but also understand that the real estate market here in Toronto has a long track record of outperforming. And I think, if anything, the one thing that I've learned in examining the GTA real estate market, and in particular the condo market over the last decade or so, is that it always does better than I think it's going to do, right? As an economist by training, I've been told, time and time again to sort of look at all of the sort of negative headwinds for the market and make a judgment call and try to be as balanced as possible. So that's kind of what we try to do. But, you have to recognize that the market has always done better, I think, than most people thought. And, when large organizations put out price forecasts and they're looked at with sort of, a lot of questions, usually they don't come to fruition. Usually the market does better, right? And I know there's a lot of scrutiny being put out there to CMHC's recent forecasts, and I think a lot of people are looking at it and saying, well, this is not what we're seeing in the market. We're seeing prices hold up, and in fact, in some cases, homes are still selling in multiple offer situations. So how do we ultimately get to a position where prices are down 10 to 20%? We'd have to see the market drop really far from where it is right now. And I think given the mood in the market, it's hard for people to conceptualize that. But, we do have to recognize that, things are changing quickly, and they're going to continue to change. And we have the most amount of stimulus propping up this market that we've ever seen, coming from both the Bank of Canada in terms of the record low interest rates and the quantitative easing that's occurring, but also the fiscal support, the income support that's coming in, mortgage deferrals, all of that. So these aren't normal times, and those aren't normal things to support the market. So when you kind of strip those things away, you have to understand over the longer term, what are the fundamentals? And I think anybody who's in the market today should really take a longer term look at their purchase or their investment. And buying for short-term speculation in this market is something that I strongly would not advise.
So that brings me very nicely to our final question, which we're asking all our guests. Would you buy or sell a house today?
Would I buy or sell a house today? I think so. I think I would. I probably wouldn't sell. I like to keep real estate, but to buy, and I had, a long-term time horizon, and I was looking at a market that's been pretty insulated and has historically been pretty insulated, namely, single-family home markets within the downtown core or areas around the downtown core that have historically always done well and experienced very minor disruptions. And I plan to, invest in that unit or live in that home for, at least 5 or 10 years. I'd be fairly comfortable if I found the right property, because I think the sort of central area of Toronto is so supply constrained that when you find that property that meets all of your criteria, you have to kind of think about it really seriously, because those opportunities don't come around a lot. So, buying it and renovating it and selling it within 2 years, no, but, holding on to it and investing in it over the long term, I think is something that I would still consider.
Thank you for joining us, Shaun. This has been great.
Thanks for having me.